once again, it was September. I almost said August.
September. Spring
it's September.
is here.
Spring, meteorological spring.
Yeah, whichever. It's good enough for
here.
me.
Because there was a big debate about that. And we've seen some interesting moves on the market. Hammerson, given July's performance, has been quite a surprise. But with September, we've also had a new wave of tariffs that have suddenly been imposed on China. So we find ourselves in a very horrid place, and the rand has sort of gone from 15 rand 30 all the way up to almost 15.50, all the way down to and it's just been up and down.
Yeah,
15,
but
15,
staying above
10.
15.
Yes. And everything is a mess. So, we're almost at the end of the year. We've seen this horrific just performance of the market in general. And we're starting to see, and perhaps let's focus on the US first, we're starting to see a lot more frequent downs, so closing red with the Dow and the S&P, and again, talk of a recession is picking up. Where are we?
Spooked.
Okay.
I mean, so starting with the US, the US market looks a little fragile, and it can still go higher. It can still get above 3,000 on the S&P and the like, but it's starting to look a little fragile. And there are a couple of things that are leading into it. One is the rate cuts from the Fed, which means that they're slightly worried about the data that they are seeing. Expectations for S&P HEPS growth next year is low single digit. This year, a lot of it was helped by and last year and this year by the tax cuts that the corporates got.
Yes, thank you.
Yeah. So the Fed is warning. We've got rate inversion, which was my word for 2019 and is now officially happening. And that doesn't always, but every recession is preceded by a rate inversion. Not every rate inversion leads to a recession. But certainly it's more than 50-50. And when you consider that the US hasn't had a recession in over a decade, and that in of itself is a record-setting period, you bring in rate inversion, you bring in the Fed. That's certainly cautious, for want of a better phrase, and the markets are spooked. And I think the last point, and you mentioned the rates and Trump, so he put them on and then he pulled some back from computers and cell phones and stuff like that, and China's retaliating. And I really think what's starting to happen is that the market is just starting to, in an ideal world, the market would like to start ignoring Donald Trump's tweets. They can't. He is the president of the United States of America.
He is the chosen one.
Yes.
He said so.
That's from himself.
Yeah.
But he's kind of getting whipsaw. What markets want more than anything, and this is applicable in any geography you look at, what they need is some level of certainty. What they kind of need to know is that when they wake up on Monday, it's going to be the same rules when they go to bed on Monday. And Trump's thrown that under the bus, and most particularly at the most recent G7, where he 1 minute he's going all crazy on China, then suddenly he's not, and then he is, and then he's having phone calls, and then the phone calls didn't happen, and it's leaving the markets very, very skittish, which, they've survived, coming up on 3 years of it, but I think that at this point, with the aforesaid concerns around recessions, around inversions, around the Fed, it's starting to make the market spooky. And I mean, I do year-end presentations for Standard Bank, where I look at the year ahead webcasts. And I'm starting to give thought to what will be 2020, and I can't see a green S&P 500 in 2020. It's just, whereas for the last 6, 7, 8 years it's just been easy onwards and upwards.
So the one thing I wanted to touch on as well, staying on the global sphere, is Brexit has sort of been not happening for 2 years now, and now you've got Boris Johnson, who's threatening to shut down the government until the deadline, there's a lot of things that he's doing or he wants to do just to force this through. Say his plans, his little strategies, maneuvers succeed. Shuts down Parliament until there's absolutely no time and they have to just go with whatever they've got. And then there's no Brexit deal. There's like a hard, rough, here and there and everywhere Brexit. Where does that leave the global economy? Is Britain, or is the EU-British relationship so big that us as the rest of the world need to be concerned, or
it's going to hurt?
I mean, do we, especially relative, I suppose, to the Trump?
Yeah, it's going to hurt. And hard Brexit, which is what Boris Johnson is aiming for, 31 December. And he's just doing the populist move, which is becoming popular with politicians around the world. It always has been to a degree. It's just becoming, I think, maybe more so more recently. Will there be impact in Europe and to the rest of the world? Yes, there will. The significant impact is obviously going to be in the UK. And I'll give you an example. The motor vehicle manufacturers in the UK, of which there are not many left, they work on just-in-time. So they typically have spare parts for 4 hours. In other words, they've got trucks arriving every 4 hours. These trucks, in many cases, are coming across the channel. Right now at the channel, you basically just drive up, they scan your number plate on the truck, you flash them ID, and you drive onto the ferry and you cross the channel. And Dover's doing tens of thousands of trucks a day. If you delay that process by 5 minutes, the whole thing collapses. And the implication is twofold. The manufacturers in the UK can't manufacture until there's a resolution made, and that resolution needs to be, they need to rework their supply chains. I mean, this isn't a case of let's be quicker with passing people through the border, because that's called the European Union. So what we get then is they need to move away from what has been a global trend to just-in-time supply chains. It's Tim Cook at Apple. His claim to fame was his global integrated supply chain, and he did it spectacularly well. The idea that Apple can sell 70, 80 million iPhones in a quarter is just a staggering number. I mean, I don't know how you make that many. Never mind get them into the hands of the right customer in 100, 150, 200 countries across the planet. It's staggering. So it hurts the UK a lot. We're already seeing the pound at decade lows against the dollar, particularly today. We're talking Tuesday, and the pound's been under significant pressure, GDP. But it then also hurts the suppliers in Europe, because suddenly in the short term, their customer has disappeared off the radar. They can't get those goods to the customer.
Yes.
They know the customer's there. They know the customer wants the good. They just can't deliver it. They just can't deliver it. So it has massive implications for them as well. That will shake its way through the system, and assuming the same number of cars are manufactured and sold, the customer in Europe is going to get the supplier in Europe will get their business going again. In the UK, they're going to have, because of changes to supply chain, they're going to have cost increases, and the biggest is holding an inventory.
Yeah.
Which in one sense is a one-off cost, boost your inventory, but you need the space, so it's warehousing. It has impacts on your balance sheet and on the cash flows, etc. So it does have implications. And again, prefaced with what I said earlier around concerns around the US economy, the UK is. It's not an insignificant economy, and again, bringing this together at the same time is not good timing for global markets or global economies for that matter either.
And yet here we are.
On the southern tip of Africa.
Yes, affected, even though this isn't part of our struggle. Okay, now coming back home, while August wasn't too bad, I think financials had a very it wasn't great. I mean, Aussie down 2.4%, but banks, financial services, or the financials industry as a whole, down 3.7%. But life insurance down 4.8%. What is going on?
I think the life insurers, and we've touched on it earlier the year, I think there are a couple of things hitting them. On the one sense, remember that they have their float, which is the money which they're holding until we claim.
Yes.
And that money
they can't use.
But they can invest it. They can stick it into investments, some short-term, some long-term. There's all the rules around that. But they can invest some of it, and the rules have become stricter. So they used to make nice money off that, and in the current market, simply they're not.
You can't, yeah.
They can't make money. Second to that is just a consumer who, there are no new consumers coming into our market saying, please sell me a life insurance policy. There are existing consumers who are exiting, who are shopping down, shopping around, being aggressive. I phoned my car insurer just for the heck of it, I was literally at an airport and I had 20 minutes. So I phoned them and I said, you charge me too much. And they said, well, how much is it, sir? And I said, oh, awkward question, can't remember, but I want it to be lower. And they did. They sliced 18% off my bill.
Wow.
So I'm going to, next time I'm at an airport, I'm just going to phone them randomly every time, because of course it's and that's the scenario. I'm sure if I had life insurance and I phoned them and said, this is costing me too much, same scenario. And life insurance is, of the things that we are as a family unit or an individual prepared to cut back on, life insurance shouldn't be, but is at the bottom. And truthfully, there's things that are ahead of it that need to be ahead of it.
Yes.
Education, without a shadow of a doubt. Transportation, you need to get to and from work. Food, clothing, a home. I mean, life insurance, we could argue it should be ahead of DSTV, but it's still down on that list. And it's tough out there.
But I suppose, the life insurance thing is it's the era of human nature where you don't want to think about dying, and then you don't want to have to pay for thinking about dying. Therefore, obviously, DSTV.
No, I know. And DSTV is live now and immediate. And life insurance is also, depending on your age and the price and everything else, but it still feels. I used to have life insurance. I no longer need it. And even then, I remember it going off every month, and it was, I can't remember the amount, it was, I don't know, say 10 grand a year, maybe 15, I forget, but it felt like a big dent into my spending power every year. And it was, I get the why, and I love my wife, and I don't want her to have hardship, and in the event of my death, and I looked at this, and I used to think,
but not like this.
Couldn't she just marry somebody else, maybe like a matchmaking thing at the funeral?
Tinder funeral. Onto individual stocks now. I wanted to actually touch on a stock that you love so dearly that has had a very terrible reporting season and the year, and for all the reasons that every other retailer has just not been able to perform as well as all investors would like them to. So Shoprite down 26.9% in August.
Horror month, horror
results. It was just yikes.
Yeah, so if we drill into the results, so it has been, this is a stock, I think it hit 280 at its high, and it's now 112-ish, I know, because I've been carefully buying, and every time I buy it goes still lower.
And you're like, no.
They're going to give me a board seat soon. The problem is that I think those board meetings, you get baked beans. The Woolies ones, you get chuckles. I'm sure you get chuckles.
I'm sure you get. Oh, yeah. I'd love to be in a Woolies board meeting.
So we need to break the Woolies results into two halves, and then break those two halves into two halves. First, let's look at Africa, where they lost 265 million.
Yeah, because that was where the impact came from.
As recently as 2016, they made 1.6 billion. So for rounding numbers, let's call that a 2 billion swing. That is humongous. It's driven in large part by tough economies. It's driven in larger part by hyperinflation in Angola, and just generally by weaker currencies through the continent relative to us. So you make the kwacha or whatever, and you bring it back to South Africa, and it's just not as many ZARs. And that is one of the risks of investing of doing business into the rest of the continent. My sense is it will start to stabilize. The currencies at perhaps much lower levels will find their bases. Hyperinflation at some point ends. Angola's now maybe as much as 18 or 20 months into that, and at some point it starts to stabilize and work its way out. And in many cases, a higher oil price would be a significant benefit to many of these oil-rich, particularly on the West Coast, thinking Nigeria, thinking Angola and the like, Ghana, etc. So my sense is that all is not lost in Africa. It's really, really tough. I hope that the Shoprite board isn't looking to exit Africa. They've been there since the early 90s. It's been slow and steady. It at times hurts, but on balance, it's going to be more good than bad. Then the second half is obviously RSA supermarkets, which is the Usaves, the Shoprites, the Checkers, etc. They did okay, and if we divide that into two halves, the second half was much better. And that's because of their own self-inflicted problems in the first half, which was strike action at their DC, implementation of a new SAP system, basically group wide, which saw shortages. They essentially gave competitors, and that mostly that would be Pick and Pay, they gave them market share on a silver platter. They phoned them up and said, hey guys, yeah, have some of our customers. That has reversed in the second half. They've got sales back, they got margins back. I was surprised. I'd expected margins to fall more in the first half, and I expected the recovery to be slower. But they're back at 5.5, which is where they typically sit. So South Africa is actually looking fairly good, all things considered. It's Africa, and it's also, it right now, if you, I mean, it's not even a case of putting out bad results. If you're the CEO at results presentation and your tie is crooked, your share price is going to get hurt. Now, make no bones about it, Shoprite, deservedly messed up and paid the price for it.
Yes.
But to my view, people have to continue eating. Shoprite is the...
We won't stop just because the wheels
No.
falling apart.
And Shoprite is the dominant leader of low LSM food in the continent, and particularly in South Africa. Now they're moving a bit into Woolies space and Woolies down into their space, but they've got that model. As you sort of move up from the bottom, you're at the U-Saves, they've got their containers in the townships and the like, and then you pop into Shoprite, and then eventually you migrate up to Checkers as your wealth improves.
Yes.
Which isn't happening right now.
No.
So the inverse is happening. So people are shopping down. And I know that Ian Moyer at Woolies will deny until he gets David Jones fixed that Woolies is not as expensive. It's perception. And perception is, if I'm at a mall and I've got a Shoprite and a Woolies, Checkers and a Woolies, I would think, well, am I feeling rich today? Yes, Woolies, no Checkers. Whether that's true or not, and I do think that on the basic low LSM foodstuffs, then Checkers, Shoprite is cheaper, and people are going to eat.
So I have an app that I use, Zolzi, and I must say, when you actually want to compare in real time between two stores on one single platform, you're able to actually see the difference. And trust me, some of it is perception, but my experience has taught me that a lot of it is just reality.
So I agree with you, and I have.
Even if the difference is like 50 cents.
But this is a consumer right now to whom 50 cents matters.
Matters, yes.
And that's the important point. And
I must say, for me, 50 cents matters.
I do it the old-fashioned way. I just stand in Shoprite with my Woolies app open on the phone and check the prices. I didn't know you could, but that's just it. And and I know that, and basket for basket, I'm sure Ian Moyer can pull out a basket that's comparable. But 30 plus rand for 2 liters of milk and $50 for chuckles and stuff like that. I mean, you can maybe kind of on certain items at certain times, and perhaps in the fresh, but Shoprite is cheaper, and that is the perception out there. And the last thing that continues to hurt them is just under 10,000 items that remain in deflation. And that is partly supply chain, and that is also partly Shoprite getting back their market share and keeping market share. And that's great for consumers. It's not great for them because like their rents aren't in deflation, the salaries aren't in deflation, their power bill and security bills and everything else isn't in deflation. So really, really bad numbers for Shoprite. I'm taking the view that, I'm looking if they're going to be doing, say, 10 or 11% HEPS growth on average over the next decade, which is below what they've done in the previous decade, at the current sub 120, 115 share price, I think it's a great buy. That said, can it go lower? Sure. I mean, every time I've bought it in the last 2 weeks, it's gone lower.
It's gone lower.
And
How
secondly,
low can it go?
And secondly, at what point does it start going higher? And probably right after one capitulates. So in other words, if you're going to buy it, this is not a get rich quick. This is not Shoprite is not a get rich at all. The Shoprite's just a nice steady. It's going to pay you good dividends. People are always going to eat. But this isn't going back to 250, 200 or 280 anytime soon.
So for anyone who would have listened to our podcast last month and decided to buy some braids straight after, might be a bit happier today. So braids in August, third best performing company on the market, and up 26.1%. According to our rankings, it went from 102 to number 3. First is Harmony and second is Anglo Gold. So even that is, I mean, those two, not surprising, but wow, resources.
Yeah, and gold at levels not seen since 2011 when the US got downgraded to only AAA.
So we're in a good market for gold. Well, if you bought a while back, you'd be happy now.
So if you bought a while back, gold is looking good. Where's the future for gold? And the short answer is, if the concerns and troubles remain, gold will probably move higher. As those concerns and troubles get more concerning and troubling and become more reality, it will continue higher. The ZAR will weaken. Gold will do great. Gold miners will do greater. But here's the point with gold, is that at some point you need to sell it. This isn't a buy it forever, because either one of two things happens. We are in the end of the world, in which case your gold has had no value, or at some point the crisis happens, and then investors and traders, they sell everything. They need liquidity, and they sell their gold because it's highly liquid. They sell their miners. So, and I remember this from 2008. Gold did great, ZAR, but then it didn't last, and it all came back. You've got to time it. You've got to take your exit to that. And I sort of do my investments on the two extremes. On the one extreme, I buy stuff and I plan to die owning it. And the other extreme, I trade Aussie futures, where sort of pre-open in the morning, where if I'm going to trade for 12 minutes, that's a long time. And that middle ground area is not my expertise, so I leave that to the gold bulls. Brait was rumours that they're going to be selling some of their Virgin Active.
Yes,
it's the one business.
We did speak about that.
And the market very much liked it. It's the one business which they can. They've got some others, but a lot of them, it would sell them below majority stake, and that is obviously of concern. And that frees up a lot of their debt. They are trading at significant discount to net asset value, and we can debate their valuation methodologies, but they are truthfully transparent. They tell you what the EBITDA multiples are that they use. We can go and check those up against competitors in the listed space, locally and globally, and I don't think that their net asset value is stretched. I think the market has got a few concerns. One is the head office cost is chunky, and the head office, and the market is now saying, to what purpose is their chunky head office cost?
Surely you can trim some things.
Well, I mean, trim
or
it.
the whole thing.
No, there's an argument out there being made to say, you know what, just unbundle all of Brait, just make it disappear and give the assets to the shareholders and give me that NAV you talk about. And part of the reason around the head office as well, and the concerns around the cost structures, is that in the olden days they had the golden touch, and New Look showed that to be more than just wrong. I mean, New Look, they wrote to zero, and it's actually going to be worse than zero, because they're giving up equity to bondholders. So, you know, how low can something go? The answer isn't always zero. It can be lower. And they're currently experiencing that. But the market liked the Virgin story and potential cash flow coming out of that, which will help some of the debt. And I think it was also perhaps just looking at that significant discount to NAV. I mean, more than 50%, which is, you know, typically what you would do is a holding company is you say, we've got our net asset value, what discount should it trade at? They always trade at a discount because there's drag at head office. And what you do is you say, well, what is the annual head office cost? Multiply it by 10, and that gives you the percentage it should trade at discount. Even being jaundiced on Brait, that comes to a discount of 30 if you really want to be aggressive, 35 or 40%, not plus 50.
Yeah, not certainly not. Hammerson, another one that swung from, so Brait was at 102, Hammerson was at 101 position last month, now at number 7, up 18.1% in August.
Yeah, so you can. So in one sense, it boggles the brain, right?
Because that's why I couldn't, because I wanted to say, but how?
Because we've seen some results out of UK landlords, and they're anywhere between ugly and very ugly. They've got a part of their bankruptcy law in the UK is where you can just go to your landlord and say, basically cut my rent or take it back and cancel the lease. Famous Brands most recently did that, which is great for the businesses but not so great for the landlords, and it's designed as that and I can't remember the name of it. Not important. And we've seen, and certainly the second tier landlords have really been getting a solid stick. Hammerson does have, a very, very solid portfolio of assets. And the market is taking the view that they were too deeply discounted, that they can manage their debt, that they can manage that, yes, the forward-looking statements are not as robust as they have been in years gone by. But Hammerson is an A grade, and we can see Capco wanting to break up because they've got A and not A. I don't know whether it's B or C, but with their Covent Garden and their Earls Court, and Covent Garden being the A grade. And Hammerson, you look at it and you say, this is quality A grade businesses, and isn't having its lunch handed to it to the level of the high street operators who are struggling, A, because of concerns around Brexit, and wait until Brexit actually happens. Excuse me, and the high street stores don't have stock and customers don't have money or confidence, etc. A lot of Amazon ordering, that's going to be complicated when they can't get the Amazon goods across the channel. I mean, it gets complicated. But what we have seen is a number of stocks, and a very, very large number at that, which have been absolutely pummeled and at some point are going to give us a bounce of, 18% in a month is a staggering number. If you got that in a year, you would be happy.
I mean, under the current circumstances.
And there is a lot of solid value out there, but what the market continues to do is pretty much be focusing on the sort of Googles, Facebooks, Amazons of the world, and sort of discounting everything else, almost left, right, and centre, and resource stocks because of commodity prices.
I wanted to close off by just touching on Woolies, and part of that, and we did, but when you started speaking about it, I hadn't intended on us chatting about Woolies because we've done so for a while, but I came across a tweet a few days ago that basically, it was one of those, those alarmist tweets by those shady
no-name characters,
Twitter accounts, and then they're followed by like 50,000 people or whatever. And this guy basically said, Woolies is a mess, they'll need a bailout, everybody, it's all done, it's all gone. And to have to hop on and be like, yeah, I mean, yes, there are troubles, but that's absolutely not what is happening. So I feel like we need to clear the air. So where is Woolies? We know, and a lot of people, I think, miss the David Jones story. So when they hear that Woolies is in trouble, I mean, there were people on some, job losses in SA, and to, when there's that tweet storm and you come in with your little shouts and you're like, no one's going to get fired. South Africa's okay.
Yeah. So Woolies is, I think I saw the tweet and was talking about their debt being more than the equity.
Yes.
So South Africa actually was quite good. And again, 2 halves to the year, the second half better, which is really weird because so we just got GDP for Q2 at 3.1%, which after they revised Q1 to minus 3.1, so call it zero for the year. But local food consumers were doing okay in the second half, or their financial second half, which was Q1, Q2 of this year, and that boggles me a bit, but I think some of it was efficiencies in the systems and the like, and maybe that second quarter was better. First quarter was abnormally because of load shedding. It wouldn't have been a great quarter, but load shedding is what took it to the minus 3.2. If we look at Woolies South Africa, food doing as always great. Clothing worked for a change, which with Woolies is the exception, not the rule, unfortunately. And they And they promise us that this time it'll work. They've got it right, and they're going to stop chasing younger fashion, and they're going to aim at sort of. They got a fancier word for it, but essentially middle-aged people, and they don't call me middle-aged. They got a much nicer euphemism for that, and that was the accusation that they'd run off and tried to chase after a genre of fashion who don't shop at Woolies.
Because they don't have money.
Because
Millennials don't have money.
Hey, right now, ain't no one got money, except the very rich. But David Jones it's a disaster, and they have written it down by 50%, and even now Ian Moyer is finally admitting it was a mistake, and he's off to Australia to try and fix it, which leaves us with a sort of CEO survivor in Cape Town, because I imagine that's it, he'll fix it and swan song out, which means that there's a whole bunch of peeps in Cape Town who are busy trying to become the next CEO, and there's some undoubtedly highly qualified people who can do it internally. I'm not worried about that. But David Jones has turned cash flow flow positive, and made a profit, and will hopefully pick up. The Elizabeth Street store is still only due for completion next year, but is starting to come on stream. And what they did, apart from chronically overpaying, is they then kind of took South Africa and tried to stick it on David Jones, and it hasn't worked. And they've pulled that back, and they're understanding. And for example, they want to roll out food, and what are they not doing is just drop South Africa in.
Yes.
They're piloting, they're doing little tests here and there.
I think they're going to do the garage.
So they're doing some BP, and they're going to do some in-store as well. And what they're understanding is that, yes, we're all in the Southern Hemisphere, and yes, there are a lot of South Africans in Australia, but no, they are different markets.
Yeah.
Back to the debt. Your debt more than your equity is wrong, is bad, is accounting 101, an evil thing. But only if you are in dire straits, and they are cash flow positive. They can afford that. They cut the dividend, but they are able to pay their debt requirements. Now, that debt requirement should be half the size. And remember, they did a rights issue at the time as well, and a lot of the rights issue went towards David Jones. So certainly it is far from an ideal situation, but it is, I don't see, and I saw the tweet and I crunched the numbers, and I spoke to friends of mine who are CAs and CFAs, and in other words, far smarter than me, and they came back and said, look, this is not a pleasant place to be, but they can trade their way out of it.
Yeah.
The statement that they're going to need bailouts, which I assume is a rights issue, or are going to be going broke or something.
That person legit meant like the government.
To bail out Woolies?
Yes.
For free chuckles?
Yes.
Yo. Noted.
And so that's why I just wanted to bring this up, because I was like, first of all, the government wouldn't step in like that, but also let's get it straight.
Yeah. So, I mean, Woolies is in a precarious place, but they, truthfully, I think the worst is behind them. The stock is up maybe as much as 20% off the lows of earlier this year. It was around the mid-40s. It's now around the mid-50s. It's moving in the right direction. It is not fixed. Locally, it needs a stronger consumer. What they're doing well, but they need a stronger consumer, and who knows when that comes. And Australia is probably another... maybe by the end of 2020, so their year end is June, so maybe they're 2021. So they're currently in their 2020 financial year, which runs until June, and Elizabeth Street will be open by then. And if we want to be generous, we would say it's fixed by then. I'm taking the jaundiced view and say, let's say by June 2021, it will be fixed. The worry, of course, is then, of course, the Australian economy, South African economy. We know Australian commodity, very commodity-based.
Yes.
And I know China is talking about doing some more building and the like to boost commodities. But China is slowing, and off an immensely high base. But they're slowing, and they're also moving to a consumerization of the economy as opposed to an industrialization. They're no longer building the country, they've now built it. They now want to make the people richer.
Yeah.
And that could have an impact. But Woolies isn't going broke. They just made the worst deal of...
And they're working. They're trying to work their way out.
And I think Ian Moyer... And he's been spending a lot of time there. I think he can fix it. I know people who've been to the revamped Elizabeth Street store, and it is so. It's kind of like the Harrods type scenario. I've never been to Harrods. I went to the B grade Harrods, Nichols or something, Nicholas or something.
So Harrods is like the UK Bloomingdale, basically.
Okay, I haven't been to a Bloomingdale's either.
Oh.
I don't travel as much as you.
It's fine, but Bloomingdale's is sort of like you walk in and then you realize you cannot afford a single thing, so you just walk straight
and that's what their Elizabeth Street... And what they do, if you want to come and sell your overpriced shoes or whatever it might be in their store, you pay rental space to be there.
Yes, it's Bloomingdale's. Yeah. So Bloomingdale's, each floor is several brands on each floor, and then you just go through all the floors feeling really poor, and it just completes the whole experience because you leave with absolutely nothing.
And then of course they've got their other, they've got their other stores and the like. And my sense is that, make no mistake, it was a terrible transaction. But I think the worst is behind them. They're not out of the woods, but they have a map. And I think Ian Moyer can do it. He is a highly skilled individual. He's also got David Neal on the board now, who is Clicks, who's one of the best CEOs our JSE has seen.
He did really well for Clicks.
He did spectacularly well for Clicks. And just to quickly veer off, one of the things he did spectacularly well for Clicks was succession planning. And and now I can't remember the gentleman's name, who used to run UDP, which is their pharmaceutical part. But it's one thing being a great CEO, it's critically important to bring the rest of them up with you. And my sense is, if I look at the leadership of Woolies, who's left in Cape Town, is there's conceivably 2, 3, or 4 people who can take over from Ian when he finally fixes David Jones.
And can leave in peace.
And can leave and go to Bombay Beach or whatever it is.
All right, Simon, thank you very much for your time as always and for clarifying that Woolies tweet. It had me incredibly concerned, I must say. But, you know, this is what we're here for, to try and just weed out the misinformation.
And it's what Twitter does best.
Yeah.